Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty. Hope you're doing well, giving our weekly market update and some interesting stuff going on. So let's jump right in and see what we can get you some information on today. So, everybody's been talking about the lock-in effect is keeping homes off the market. How long will it last? What this means is people have a lower interest rate, two, three, maybe, in that range. And they're looking at the interest rates right now and they're like, I don't want to move, right? So it's slowed down the market a lot. We need not only lower interest rates, but lower interest rates for a sustained period of time. Now, we're not going to see 2 or 3% interest rates for a very long time, guys, as far as the normal fixed rates and where they are without doing any buy down programs and what the incentives are with builders and all that kind of stuff. Just what the rates are and what the regular pricing is. We're not going to see those for a very long time. Even if things go the way some people hope, maybe after November, let's just say. It's going to take a while to get the wheels back on the carriage. Okay, so there's been a lot of nonsense going on in the economy that is basically about supply and demand. You want to know why it costs so much for energy? You want to know why it costs so much for all these different things like food and all that? It's got to do with supply. So if we give the power back to our farmers, if we give some power back to our cattle ranchers and all that sort of thing, if we produce our own energy dominance, okay, and I'm all for green energy when our tax dollars don't have to pay for a ton of it. Okay, I'm good. I'm good without that. But a lot of the energies that are quote unquote green, when you take a look at what they actually do to the environment and the land and the birds and all that sort of thing, little crazy, right? A little crazy, not so clean, and a lot of it still takes diesel and coal to run it. It's crazy stuff. But anyway, that's a whole nother story for another conversation. But what drives the economy is our energy. It costs more money to transport this stuff and all that. We need more supply of it. When you have too few dollars, too many dollars chasing too few goods, we have this inflationary thing. So we need to get back to some sense there. But until that happens, we've got this idea going on here, the lock-in effect. Now, people have to move. If people really need to move, they're bursting at the seams, their family's growing, or they have to move for job, family stuff, whatever it is, they're going to move. Okay. So those are the people moving right now, and investors, which I'm going to talk about today too, a little bit more in detail. Excuse me, allergy season. Anyway, let's take a look at what's going on here, though, and that is more sellers are cutting prices as home sales slow. Inventory, at least in the Phoenix area, some places around the country, it's still overall low. We're nowhere near the crash. So crash is not happening, guys. I repeat, crash is not happening. The market is just slowed to a very balanced market. I would call it like a stagflation housing market. It's just kind of like hovering there, like homes are going to sell every day, no matter what the market's doing, no matter how high interest rates are, even though these are kind of historic averages. We just got spoiled for so many years because they juiced the rates for so long. So things have just slowed down. People's overall appraised values have shot through the roof over the last 2 or 3 years with all-time high prices, but things have slowed because the rates are super high. Prices went up. If you double the prices of homes, you double the rates, things slow down a little bit, right? People just, have to think twice. It takes two people to buy a house, and maybe their parents helping them at the same time in order to make it happen, right? Um, People think twice about selling their house before they move if they don't need to, right? But there are always going to be the need tos out there and the investors out there, in every market. So some states are better than others for investors, and yeah, we can get into all that, but there's still investors. We deal with wholesalers, we deal with investors all the time in our market, and it just is what it is. So, but this is happening. This is happening where we're seeing more price cuts. And it's like, Chris, but how are we at all-time, high sales? Again, supply and demand. Inventory is still low. Okay. We're still at very low inventory overall for where we want to be in a market for choices for home buyers and all those sorts of things. So, when we look at what we were just talking about with the rates, see the 10-year treasury, that's going to drive our mortgage rate pricing. The splits between the two have definitely gotten better over the last year. So that's good. So when the rates do drop eventually, which by the way, they're saying if we're lucky now, if we're lucky, okay, the way they want to run the economy, if we're lucky, we're going to get maybe one rate that, cut this year now at this point. Um, Rates have just been up, below the average national retail rates that you see out there on the news. They're, 1 week they're, above 7, 1 week they're below 7 a little bit. Beginning of the year, those numbers were like, in the mid sixes. And everybody got excited about that, of course, towards the end of last year, up until about February. And then the rates went back up. They went all the way back up again. And it is what it is. Slow things down. You can't go by what, necessarily what the comps were during that period versus now with the volatility in the market. This is a lot of people are just like, shh. Or they're going to do a lot of these incentives that they're getting through new home builds, which make up about a third of our market, the new builds. Okay. And that's really the new fresh inventory. Although those numbers are nowhere keeping up with the numbers that we need for the entire country or here in the Phoenix area, nowhere near it. They've actually slowed because they know the market slowed. They're in the business of making money. They're not the March of Dimes. So they're going to do, what's right for their pockets. And they know what happened during the crash. They're not going to overbuild. They're just not going to do it. Not the way, especially the way things cost. And it's costing them money to buy down these rates for the incentives they're giving people. Plus, they're paying closing costs and everything just to keep the lights on and keep the businesses going. Everybody's hurting that way now, until we get to economic sanity once again, and get our supply under control. Which, again, could totally be done with the right approach, but that's another conversation. Now, the average rate as it ended today was right at 7.17%, down a little bit. Again, these are just up and down, up and down, up and down. It's just kind of hangs there. I told people this before too. When you look at decade by decade, you kind of see an average for each decade. 2000 to 2010, you saw the average was probably going to be around 6%. The decade before that, 90 to 2000, about 7.5%. Okay. The historical average is kind of like where we're at now. Okay. So a lot of times these cycles, again, it could be who's running the economy, of course, and other factors, obviously. But and a lot of this too, does have to do with some of the food stuff and shortages that we're seeing, through the wars that are going on right now. I don't want to get into all that, but that does have an impact on some of these things. Okay, so some of it again, I think could be handled better, but that's just my opinion. Anyways, pending home sales slump as mortgage rates rise. Again, things are slow back down. And some of us had, higher hopes for this year. Again, not to say home prices are plummeting or anything like that. They're certainly not. We're at all-time highs, price per square foot. We've gone over that the last few weeks. But things are just moving slower. You're not going to get these, crazy top end prices that we saw even just a few months ago, where, we saw rates dramatically drop. We had a little bit of a frenzy like we've had a couple times in the past couple of years where, rates, started going up in 2022, but we had a couple of little periods where rates drop a little bit, get a little frenzy going, and then rates go back up again. So, it's just, you kind of got to leave that faucet going a little bit longer, on getting things going. And it doesn't have to be juiced. It just has to be allowed to breathe and allow the economy to supply itself. So a third of homes for sale are new constructions. I mentioned that. that is still not enough to keep up with the demand, believe it or not, overall demand, even with these higher rates. Okay, you know, if it wasn't, if we weren't keeping up with it, even though things have slowed down a little bit, we would see crazy inventory just sitting there and for with months and months and months supply. We've been hanging around that 3 month supply mark, maybe mid threes, low threes in Phoenix area. So I mean that's just kind of where we are. National average is going to be right around the same thing. Again, every areas locally is going to be a little different. That's just kind of where we are, guys. We're just kind of hanging there. Now, here's a question that's come up, and it's a great question. Are investors re-entering the housing market after a 2-year retreat? Well, here's some stuff I'll just read from you here. It's real estate investors bought about 44,000 U.S. homes in the first quarter, and among the homes they're selling, they're reaping bigger profits than they were a year ago. Okay, so investors are doing really well, and I got to tell you, really impressed with a lot of people. We do some wholesaling with some of our investor friends and stuff, whether we're on one end or the other. Um, it's a great way to keep things moving along for us, especially during this sort of periods and things like that, where the traditional sales aren't happening as much. But we're seeing, with the wholesalers and with investors, they're doing really well. So March went for, let's see, the typical home sold by an investor in March went for 55.2% more than the investor bought it for, up from 46.3% a year earlier. Only 5.3% of homes tracked by Redfin sold by investors sold for a loss, down from 13.7% in March of 2023. Okay. And we talk about institutional investors. Now, in the Phoenix area, a little over 13% of the homes right now are investor properties. That's actually kind of normal for us. Okay. Now, institutional investors like, BlackRock, or, we see these other big iBuyers come in and all that. Those are people who own 100 or more homes. They get a lot of attention in a broader housing market. They're buying less than 2% of all the homes out there. So when they say that they're buying them up, as annoying as sometimes these people can be for us, or helpful, depending on the situation. According to the data from John Burns Research and Consulting, investors of all types and sizes in 2024 have purchased about 25% of all homes sold, suggesting a majority of home buying by investors is coming from small and medium-sized groups. So the mom and pop, the smaller investor, is really getting the lion's share there. Still, investors made up only 12% of the home buying activity in 2002, according to John Burns' illustration how prolific investor activity has become in the past 20 years. And for Arizona, it's huge because our gains are always usually higher than most of the other areas in the country. So that's why so many people came here to invest and build here and that sort of thing. Now, a lot of us have seen this going on. And this is the tail end of a lot of. And by the way, with new builds, we're seeing more multi family multifamily type of new builds versus just a single family. Okay, like your next gens, all that's kind of going with an increase, or multifamily new builds more than we're seeing the single family as far as the rate of increase goes. Okay, not the total number, but the rate of increase. But build to rent communities surge in Phoenix amid high home interest rates. So we had, you've seen them popped up. They're all over the valley. I hear people talk about it all over the valley. I hear people talk about it from other parts of the country, where you've got all these rental communities going in. They look like single family houses, like this right here, but they're rental communities. Here in the Phoenix area, they might go maybe on the west side, for a couple thousand. East side, maybe 3,000 to 4,000. Base prices and stuff. They have nice finishes, all the things that we want for modern conveniences. But they're rentals. Okay. And we see that surging. But again, that's that kind of that tail end wave, what we talked about with the construction market. Once those construction people lose their jobs, that's when we're going. And again, I'm not rooting for this, but this is what the Fed told us they're looking for. Okay. Nobody's rooting for this, but this is what happens before every recession. The Fed said they're waiting for those unemployment numbers to tick. They're watching that. When that goes up, look at 4.2, 4.3% unemployment, which we're seeing a lot of softening in the jobs market, but not a total obliteration yet. Like they want or they're looking for in order to really say, oh, okay, maybe we can lower rates now. I don't think that's going to happen. I mean, I don't want to put a timeline on it because we want to watch the data, but I don't think that's really going to happen this year. We may see, some of that tail end of it by the end of the year, but there's still a lot of these projects that these people are working on. So till they get out of that, and the overall, not just Arizona, but the overall economy and the Fed see this, they've said they're not really going to take a big swing on the Fed's fund rate, which will impact the mortgage rates. So anyway, we've seen this surge from all these projects that were put in place over 2, 3, 4 years ago or longer. They've been put in place or they're finishing up in the Phoenix area, around the country and so forth. Some of them are more apartment complexes, all those sorts of things too. But again, we're kind of halfway through that or towards the tail end of that. And again, nobody's rooting for it. I'm not rooting for it, but that's what they're looking for. When we see those people lose their jobs, it's not going to be like a complete, translate to another construction job over here in new build construction or something. It's not really going to translate that way because again, people are building a lot in a lot of cases as they're building with the inflation prices and what they can do. Okay. And that's already kind of baked in. So the Crawford Market Index, let me just make sure. Okay, yeah, the Crawford Market Index is giving us again a reading of a balance market. So between 90 and 110 is the balance range, 100 being completely balanced. We're at 106.8 as of today. Our supply and demand are both low. Okay, our supply is 73.8. That is about 27 points or 22.2 points lower than we would need for a balance in supply. And in demand, we are about 22 points low from a balance in demand. So it makes total sense with what's going on in the market. We also see that we have different areas of town, excuse me, different areas of town that individually are maybe in sellers markets, which Chandler is, but it's down 5%. Even Chandler's down 5%. And they've been up for quite a while. They're at 209. They top the charts as a seller's market. Fountain Hills comes in second, then Gilbert, then Mesa, Avondale, and then Glendale, Phoenix proper, Tempe, and then Scottsdale, Paradise Valley, Peoria. And then we are into a balance market with Goodyear and Surprise, and then everything else. Okay. So Goodyear, Surprise is kind of low end balance. So kind of towards the buyer end. Okay. Towards the buyer end. But Goodyear did tick up a little bit. We'll see how that goes with them. Surprise is lower and dropping. Cave Creek is a buyer's market and dropping into more of a buyer's market. Same with Queen Creek. Buckeye went up a little bit, but it is in a buyer's market, even lower than those. And then the strongest buyer's market is Maricopa City. So those are the individual stats for individual cities. Our contract ratios, again, would reflect all that. If we are over 60 on contract ratios, according to Cromford Market Index, and their contract ratio heat map, 60 or higher is a hot market. Um, Most of the areas that we're looking at are going to be more towards, like in, the East Valley, kind of mid Phoenix. Those are going to be a little bit more of, Glendale area, Tulsa. Those are actually hotter markets. Parts of Peoria, a little bit of Surprise. Everything else is either warm or cold according to the contract ratios, which tells us a lot. And that kind of tells us where we are and where things are headed over to at least the next couple months. So I wouldn't see too much changing there in those markets right now. For people trying to sell, I would say price accordingly. Go over details with your agent. Hopefully, that's us. We would recommend definitely pricing maybe a little bit more aggressive, especially if you're in a balanced two buyers market. And we've always got our 3 to 5% rule as far as what might you be looking at as far as getting it show ready if you're able to do that. So, guys, feel free to reach out with any questions at all, real estate related or mortgage related. We'd love to be able to also connect you with our preferred lender. If you have any questions about your home values, want to look at maybe doing some investing of your own, we could talk about that. But right now, excuse me, I'm sorry. Right now, maybe a good time to just go ahead, make the move, get the sale done, because some people are speculating that we might even see possibly, depending on what's going on in the world right now with all the different crazy stuff happening with wars and stuff, or wars looming, we could see possibly rates go up more before they go down. Who knows? Okay. The way things are just so volatile right now and not really on a straight progression, where people can really kind of look out. I would say, if you lock in, at least if you lock in your mortgage, you lock in your payment, it's not going to go up. Prices in your area, as we've seen, can come and go as far as whether in, sellers markets, balanced market, buyers market, could get better or worse. Who knows? So anyways, guys, if you would like any more details about your particular area, your particular home and community, let us know. We'd love to be able to help you. Thank you so much. We'll see you guys next time.